proceeding to the next session on personal taxation. We would like to welcome Saraswathi Kasturirangan, partner Deloitte India. Saraswathi has extensive expertise in expatriate tax issues and social security, offering advisory services for assignment structuring that leverages double taxation avoidance agreements and social security agreements. Warm welcome to you, Saraswathi.
Thank you, Ridhima. It's indeed a pleasure to be present and making a presentation to this August gathering. And coming after Mukesh sir, I think it is indeed a formidable task that is set out in front of me, but I will do my best. And if I could get the rights for presenting, let me just try to share my screen.
Yeah, please.
Yeah.
So the session
Please
is all yours.
Whether my screen is visible.
Yes. You can take it to slide share mode.
Yeah, I've done that. Is it visible?
Yeah, perfect.
Great. Okay. So good morning, or rather good afternoon, everybody. And yes, as Mukesh so rightly talked about, this has been an eventful budget from an individual tax perspective, I should say. And yes, everything has indeed been about the new tax regime, or the simplified tax regime, as we call it. And this is something that was indeed expected or has been an ask from the finance minister, because while in 2021, we had introduced, the government has introduced a simplified tax regime, it had not really taken off. Yes, traditionally as Indians, we are all used to having tax incentives for various investments, for deductions for payouts like tuition fees and repayment of housing loan and so on. So yes, that is something that I think psychologically we've really got used to it. So having to move to a regime without any deductions and exemptions was indeed a paradigm shift. But I think the key message the finance minister has given in today's, in this year's budget, is that the simplified tax regime, or the new tax regime, is here to stay. So as you can see, and what I will quickly cover in half an hour, and I think about 15 minutes or 10 minutes we can keep for Q&A, is what are the changes in tax rates and what are the implications, amendments to certain exemptions and reductions, talk about certain new provisions, and then maybe quickly wrap up. So let me go on to the tax rate, which are, as you can see on the screen, I've tried to categorize it as to what are the rates under the regular tax regime, which definitely have not undergone a change, but I put it in only for us to have an understanding of how it looks. And there are no changes, of course, so I'm not going to go by it line by line. But clearly, if you look on the right-hand side, you can see what are the tax rates which were there till FY23 under the new tax regime, or the simplified tax regime, and what is that is proposed in the budget. So clearly, under the simplified tax regime, the maximum amount not chargeable to tax was 2.5 lakhs, which has got increased to 3 lakh. And after that, every 3 lakh, there is a change in the tax rate by 5%. Currently, the change in tax rates was after every 2.5 lakhs, and the maximum marginal rate continues to kick in at 15 lakh. But one key difference between the rates that are prevalent till FY23 to what we are going to see from FY24 onwards is that there is no 25% rate that is applicable under the new simplified tax regime. What is also interesting is that it's not only the change in tax rates that have been made by that have been proposed by the finance minister. The basic exemption, as I called out earlier, has been increased from 2.5 to 3 lakhs. The simplified tax regime will also provide the rebate under 87A, which is now limited for taxpayers with taxable income of up to 5 lakhs to taxable income of 7 lakhs. So this clearly means that anybody with a taxable income up to 7 lakhs will have zero tax to pay, because they would have a rebate which is available to them. The finance minister also has heard the masses, especially the salaried class, and extended the standard deduction which is available under the regular tax regime to the simplified tax regime as well, which means that salaried employees can have a deduction of 50,000 rupees from their total income, from their salary income, to have a lower taxable income. And for pensioners, this amount of 15,000, which was available under the regular tax regime, has also been extended. But there have been no changes in the exemptions and deductions under the regular tax regime, clearly giving a very strong message that the new tax regime is here to stay. And over a period of time, it may be expected, there has been no intent stated by the finance minister, that over a period of time, we may need to stick to the new tax regime. What is also very attractive, and I think Mukesh sir called this out as well, that for taxpayers with over 5 crore of income, HNIs, who were subject to a 37% of surcharge, which means that the maximum marginal rate for those over 5 crores was 42.74%. For them, the surcharge has been slashed from 37% to 25%. Clearly, the maximum marginal rate is coming down to 39%. So this is something which is very attractive. Now, what do we as taxpayers, how does this impact us? What do we need to do before making a decision as to whether I go by the simplified tax regime or do I go under the regular tax regime? Maybe I would just like to make two comments here. One, the simplified tax regime now is the default tax regime, which means that if you want to avail the regular tax regime or the old tax regime, as we can call it, you would need to make a choice. You would have to exercise a choice. The conditions for exercising a choice for flipping between regimes remain the same. So if I am a taxpayer without business income, I can continue to choose year on year which is the tax regime I would want to be covered under. And I would naturally need to do a math myself, saying that, hey, these are the kind of investments and these are the kind of deductions I would be eligible to under the regular tax regime. And hence, individual has to take a call as to whether they would want to come under the regular tax regime or simplified tax regime. And as in the earlier scenario, for business and profession taxpayers, or rather taxpayers who have income from the head business and profession, they can make a choice, but it is only once. It can only be changed once in a lifetime. So that those provisions continue. These were there earlier. They continue. The only change is that the default now is the simplified tax regime, which means that when you look at the new tax return, in all possibility, the default would be the new regime. And if you want to go to the regular tax regime, you would need to consciously make a choice, which means that you have to file your tax returns in time, because if you file your returns in a delayed manner, you cannot exercise a choice other than the default option. So the default or simplified tax regime. So we need to be mindful about that. Now, I would like to go to the next slide. This is a quick snapshot of the simplified tax regime, the way it has been there today versus the way it has been proposed, as to where are the income levels where there is a tax rate change. I did call out on the earlier slide, but maybe this visual will help. So clearly up to 2.5 lakh, in both the situations, it was not taxed. 2.5 to 3 lakh, we did have a maximum amount not chargeable to tax as 2.5. That is now going to 3 lakh. So clearly there is a saving for those who have, for anybody where the tax slabs are being used, and you get a lower tax for 50,000 rupees. Similarly, for every alternate line item that you see, so between 5 lakh to 6 lakh, there is a 5.2%, and this is including the education surcharge has not been considered for this purpose. Every alternate line item, you can see that there is a 5.2% reduction in tax rates under the simplified tax regime. So if you have been under the simplified tax regime today, and if you're comparing your tax payouts under the new, under the proposed simplified tax regime, clearly there is going to be a significant saving. What is that saving going to be? So if I am a taxpayer with income up to say 7.5 lakhs, I would have paid a tax of 39,000 under the existing simplified tax regime, which would now be zero. So clearly there is a substantial saving of 39,000 rupees per annum. for individuals with over 5 crores, and I'm now jumping into the other end of the spectrum, the HNIs, where today they would have been taxed at 42.74 at a maximum marginal rate, that is dipping down to 39%. And if we look at the absolute numbers, it's about 20 lakhs of tax saving at that levels. Clearly, it would change person to person. And my gut feel is that even if they consider, say, the ATCs, ATDs, TTA, and all of that which are available, they are more likely to be better off under the simplified tax regime. So it is a call indeed for the HNIs to move over from the regular tax regime to the simplified tax regime. Now, in what happens to those who are in between say 7.5 lakhs to 5 crores? Is there anything that's compulsive in terms of the tax rates change that would move them away from the regular tax regime to the simplified tax regime? I'm not too sure. I think it is important for those who are who are today in the regular tax regime, to continue to monitor the kind of investments and save and deductions that they are claiming today, to see whether there is a need, or is it better off under the simplified tax regime, is something that each and every individual would need to take a call. Approximately, even if you leave out HRA and LTA and so on, under an ATC, you get 1.5 lakhs. If you have NPS employee contribution, you get an added 50,000. If you are a home loan, if you're a availed home loan, you get 2 lakhs loss available for self-occupied property as well. And so about 4 lakhs, if you look at it, there could be a likelihood that you would be better off under the regular tax regime, especially if you are in the 15 lakh and above kind of income levels. So it's something it's important for us to look at. One thing that is available under the simplified tax regime, and it's continued, is a tax benefit on employer contribution to NPS. That is something that was available earlier and continues to be available. So I just thought I'll share some of these practical aspects. One thing that I've kept hearing about the simplified, and allow me to take a sip of water. Yeah, one thing that I keep hearing about the comments relating to the simplified tax regime is that the government is really not encouraging individual taxpayers to continue the investments, say maybe the Provident Fund, the equity linked savings scheme investments, LIC, and so on. So is that something that to be looked on negatively? Is something, again, that has been a matter of debate. Every session that I've participated, this has been one question that has been thrown at me. And I think we need to look at things a little more pragmatically. Yes, traditionally, we as taxpayers have been provided incentives, tax incentives for investments. There are, like Provident Fund and so on, are really attractive tax benefit schemes. The kind of exemptions we have, EEE scheme, Provident Fund, for instance, at the time of contribution, you get a deduction. The employer contribution is not taxable. The accruals are not taxed at the point of withdrawal. If you met the specified conditions, then again, it's not taxable. These are very limited kind of regimes that are available. The question is, should we take away some of these deductions, which today I'm getting, say, for Provident Fund, LIC contribution, and so on? And will it indeed impact the savings attitude of our taxpayers? Well, yes and no. I would say the way we need to look at is, we've been a country where there has traditionally the social security system is something that has been run by the joint family. As culturally, we did not build up, I would say, in the initial years, very strong social security system, because culturally we've been supported by families throughout, unlike many other countries. And hence, in the organized sector, the Provident Fund was one of the limited social security regimes that was available, and hence, indeed, it did require some kind of an education to employees to make sure that they did choose to contribute to such kind of formal retirement schemes. Similarly, life insurance and so on, given the lack of formal social security system, it did make sense for the government to support it. Over the last years, we've seen in various budgets there has been a lot of focus on the NPS, the National Pension Scheme. And there has been a call out in terms of pensions available for even the unorganized sector. And clearly, we are, from a social security perspective, moving towards a nationally available pension regime. The schemes could be varied, and they would indeed need to be varied given the demographics of India as a nation. We cannot have a one size fits all. And hence, I think it's time that taxpayers make their investment decisions on their own. And it need not necessarily be nudged by the tax reliefs that are tacked to it. Yes, it can be a decision that I make saying that in terms of the amount of return that I receive, I would always look at a post-tax return, but tax should not be the driving factor. I think this is one message that we are getting from the government, though it's not been really called out. And this is something that I've heard over in many debates. I would also like to touch upon what Mukesh sir talked about. Does this mean that there is going to be a dip in this amount of small savings that we see and so on? I think some of which could possibly get compensated by the increase in limits which are provided. Say, for instance, the senior citizen savings scheme, the limit has been enhanced from 15 lakh to 30 lakh. And similarly, the monthly income scheme, the limits have been increased, and the Mahila Saman certificate has also been introduced. So I think there are alternate avenues for savings, small savings, but they are not really driven by tax reliefs. I think that's a key message that's coming. So I would like to move over. I know we've spent a bit of time on this. I'm conscious of time. Let me go to quickly touch upon various other aspects which are available, which have been made. These are some of the amendments which have been proposed from the existing provisions. So, for instance, capital gains, when there has been a sale of a long-term capital asset, which is a residential property, for Section 54. And if I've been selling any other long-term asset, I would possibly lean on in Section 54S and invest in a residential property to get an exemption from a capital gain. In the past, this has been without a cap. This budget proposes a cap of rupees 10 crore, I think, which is a reasonable amount. So that is one of the amendments that has come in. Taxation of insurance policies, we did have a provision relating to taxing insurance policies where the premium value was more than 10% of the insured amount. There is an added provision which has now come in, which says that in the event my aggregate premium in a year is 5 lakhs and above, then the amount which would be received as the proceeds of the insurance claim would be taxable. The cost of the insurance would, of course, be available as a deduction, provided it has not already been claimed as a tax benefit. To the extent it has not been claimed as a tax benefit, it can be considered as a cost, and the differential amount would be taxed. This would be applicable only in respect of policies issued after 1st April 2023. The other amendment which has come in is to clarify, I think it's more in the nature of a clarification, that interest on housing loan which has been taken either for acquisition or for renewal, if the interest cost has been taken as a deduction under Section 24, it cannot be added to the cost of acquisition, because then it would come in as a double benefit. So that has been something that has been clarified. Now there are certain new provisions which have come in. I've just picked a couple, and I think the first one, Mukesh sir did talk about it. There is a scheme which has been introduced, and SEBI runs this. There is an FAQ issued by SEBI also in this regard, where it's possible to convert the physical gold to an electronic gold receipt. So instead of having my gold, say, in biscuits or in some other form, and there are certain specified forms in which the gold would need to be handed over to the shifted to the vault manager, in which case I would get an electronic gold receipt for the value of gold, and it can be in various say 100 grams have been given, then I could get electronic gold receipts for 10 grams each, so that the liquidity or the transfer becomes easier in smaller denominations. And this transfer or this conversion from gold to electronic gold receipt and vice versa would not be treated as transfer for the purpose of capital gain. So clearly, this is to encourage holding of gold in electronic form, and there is a SEBI-directed scheme for it. The other change that has been brought in is with respect to the taxation of market-linked debentures. In the past, they were treated as long-term capital gain at 10% without indexation, where it was meeting the long-term holding criteria. Going forward, this is going to be deemed to be treated as short-term. So irrespective of the period of holding, it will be taxed at applicable rates at under section 50AA. This is one of the changes that has come in. I think there are smaller changes which I thought it will be important to call out. Taxation of gifts, there is a deeming provision that attached to a gift to a non-resident exceeding 50,000 will be deemed to accrue and arise in India. Similarly, even if it is to a not ordinarily resident, it would be deemed to accrue and arise in India. So basically, the change is that in addition to non-residents, this provision will also be applicable to resident but not ordinarily resident. Presumptive taxation, the base has been made a little more broader. The presumptive taxation under 44 AD, the limits have been increased in the case of income from business from 2 crores to 3 crores. And in the case of profession, it has been increased from 50 lakhs to 75 lakhs. The condition that the amount for business, that the aggregate of amounts received during the year, it should not, in cash, should not exceed 5% of the turnover or gross receipts, that's there. The other change is on tax collected at source. I do believe this is something that could have an impact on cash flow. There was a provision which said that foreign remittance towards purchase of overseas tour program, and there was no threshold limit for this, was subject to a TCS of 5%. For any other purpose other than, of course, education, medical treatment, repayment of education loan, and so on, for that, there was a limit of 7 lakhs, and beyond that, it was subject to a TCS of 5%. This is now being changed into 20%, and in respect of the second category, that is any other purpose, now the 7 lakh limit has been taken out. So there is no limit. It is applicable for all remittances under LRS. This is something which people who are making remittances overseas may need to look at a little more in detail. I'm not really able to fathom the drive for this. The underlying intent behind this introducing this 5% was to get these under the taxable radar, which I think was achieved with even a 5% TCS. I'm not too sure why it was increased to 20%, but having said that, the rule is now 20% going forward. Leave encashment, I think this is again something that the salaried class would welcome. The total, the aggregate leave encashment exemption that a salaried employee could avail during his or her lifetime was 3 lakh. And this has been increased from 3 lakh to 25 lakhs. So of course, the notification is yet to come, but this is something again which would be welcome, given that these limits have been set ages back. Procedurally, also there are some changes which have come in. The tax refund which is due to an employee, where there is a reassessment pending, now there has been more teeth given to the assessing officer that the refund is not payable till the proceedings are complete. And no, there would be I think this is practically being followed. And in any case, this has been regularized in the form of a regular rule, is what my sense is. Because in practice, we have seen that the income tax authorities do adjust these demands and only the net amount is paid. Again, procedurally, from a provident fund perspective, where an individual did not have a PAN, the TDS rate was 30%, and it is now being made uniform because many of these would be applicable to employees who are at the lower end of the taxable spectrum, as otherwise they would definitely have had a PAN, right? So the government has done right by reducing the TDS amount to 20%, marginally reducing the hardship in those cases. Assessment timelines have rolled back to 12 months as against 9 months, which was again a change which happened in the interim. And this change is applicable for proceedings which would be completed from assessment year 22-23 onward. I think this is the last one that I have. This is a TDS credit, which there is a procedural change that has been provided. What the memorandum talks about is there could be situations where an individual has offered his or her income on accrual basis, but the TDS would have happened when the credit of the income actually happens, which means that in the year when the credit of the TDS is due to be claimed, I would not have offered the income to tax in that year. So technically, am I eligible is a question that comes up. And hence, there has been a procedure that has been laid out in this budget. What it says is where there is an income which is already included by the taxpayer and the tax has been deducted subsequently in a subsequent financial year, the assessee can make an application to the assessing officer. There is a 2-year timeline which is given. So where the tax was deducted at source, within 2 years, I need to make the claim, and the assessing officer will go and amend the order of assessment or intimation and allow a TDS credit. The interest period for which the period for which I'm eligible for the interest would kick in from the date of filing of the application. So this is something that would be effective from 1st October 2023. This is against a procedural change. So I think that is it from me in terms of the content. I'm happy to take questions. I'm hoping I was audible.
Yes,
saw a
yes.
message. I was audible?
Yeah, definitely. It was very perfect. So can I ask you queries, Saraswathi?
Yeah, please go ahead, Ridhima.
So one of our attendees asked, can interest paid on housing loan above rupees 2 lakhs, which is not claimed as a deduction, be still available as cost for capital gains computation purposes?
I had the same thing. Many of us were not claiming the interest cost in the fact, but apparently it looks like it is something that's available because what the government has clarified is that only if you've already claimed it, which would be limited to 2 lakhs. So if I've been claiming a self-occupied property and I've been, say, incurring a cost of, say, 5 lakh as interest per year, what the clarification says is only 2 lakh that since you've claimed that is not allowable. So it looks like 3 lakh is available. I had the same question when I read this, saying that, oh, so does this mean you can claim 3 lakh? That was my response as well.
Great. Another one coming up is with people more opting for new regime, will this impact mutual funds or will it not impact them, mutual funds, insurance companies? Because many FSC invest mainly to save tax. So it's like an ecosystem.
See, I don't think so, honestly, because, and as I said, there could be some minimal impact. The only benefit that was available was under the equity linked savings scheme under ATC. And this is a debate that is going on. See, it's not just the mutual funds. Does it mean that people will stop taking insurance policies? Does it mean that PF will stop contributing to public provident fund or PF? Well, I don't think so. Yes, there could be at initial levels, and I've anyway been seeing a trend that the younger generation is finding the keeping of documents and submission of these to the tax authorities a pain. So I think what the government is trying to do with the simplified tax regime is sort of increase the protecting the tax base and at the same time increase the ease of filing tax returns. So I think that is what it is intended. It is not really intended to discourage the savings. And in any case, the limit of 1.5 lakhs has been there for years. And I think those who are at slightly higher levels of income would anyway be making investments more than that. So I don't think this would have a direct impact. Yes. And as I said at the start of the session, this has been a debate that's been going on, saying that is the government discouraging savings and investment. I don't think that is the intent. The intent is that don't make tax a decision factor in terms of, no, that should not be a driver. There are many who've realized that the kind of insurance policies they purchased, looking at tax benefits, did not really give them the right amount of returns. So it's important for us as investors to look at what is the return I'm getting from a scheme and then make a decision rather than say that, hey, I will invest in this because I get an ATC deduction. That's a wrong decision.
Correct. Next we have, is it correct to conclude that assessees between 15 lakhs and 5 crores total income and having substantial deductions under Chapter 6A be better off to remain under old regime?
Perfect. I agree so. So even if I presume that somebody with a 50 lakh income may not be staying in a rented house, they could have their own house and so on. They could possibly have a housing loan of 2 lakhs and they would possibly have an NPS of 50,000. They would have medical insurance. So I would say, yes, in fact, I would say between 15 lakhs to up to 15 lakhs, there is a possibility that I may not invest so much. I would want a higher take home. So I may not invest so much in all these ATC related deductions and so on. It's a presumption that I'm making. I would still say that everybody has to do their own math. But the tendency that this population would move more towards a regular tax regime is definitely high.
Absolutely, I agree. Can I take 2 more then?
Absolutely. I think there is time. We can take questions.
So this is very interesting. If return is not filed on time, then I have to opt for new regime only. Is that so?
Yes, that's correct. Because that is one of the implications of making the simplified tax regime a default tax regime. Today, if I had to opt for the simplified tax regime, and I'm talking about the situation before the budget 2023, if I filed a return belated and I have not opted for it, I would have come under the regular tax regime. Whereas now the situation is going to be flipped. Your tax return by default would be the simplified tax regime or the new tax regime. And if you want to opt for the regular tax regime, you would have to make a choice. And this choice or the option to make this choice is available only if you file the returns in a timely manner. So this is something you would need to be mindful of.
Right. So the next one is, if I have different policies summing to rupees 5 lakhs in a particular financial year, will the matured amount be taxable or not?
I was honestly hoping this question will not come. I did have this question. See, today there is no clarification available with respect to the insurance. The way it is worded in the proviso, it looks as if it is applicable only to that particular policy. But this provision, a similar provision was available for ULIPs earlier, where the limit was 2.5. And there, if you look at the related FAQ, it looks as if they are going to be adding up everything. So it's debatable. I don't know whether that FAQ is going to be applicable for this, but there seems to be an alternate view that you will have to add up all the premiums that you pay during a financial year. And if that crosses 5 lakh, yes, the proceeds are going to be taxable. But remember, this is applicable only in respect of new policies which come in from April 2023. And I would still like to wait for an equivalent or a similar clarification for the insurance before I jump into the conclusion. But apparently it looks like if you read these two on par, what the question is a relevant one.
Okay, so since we have 5 minutes more, let's take a few more. I think the personal taxation is one such hot topic. So next is, employees do speculative transactions, FNOs, and those income are reported under business head, correct? So that means they can't shift every year between old and new now?
They cannot. So if somebody has got an income under the head's business and gain, and this is not something that's come in from the budget 2023, this is existing under when the simplified tax regime was introduced itself, this was there, that they can only move out once. So that is clear, irrespective. They cannot do a financial year to year flipping in, flipping out. They cannot do that.
Okay. And this standard deduction of 50,000, which is very hot now, which is under the new regime, is only open for salary and pensioners, or do we seek to have more clarity on it, that it would be for all the...
Standard deduction has always been against the salaried income. Correct. For the others, anyway, the maximum amount not chargeable to tax is there. And for those who have income, say, from consultancy or business and so on, you can always deduct the related expenses. The
Correct.
concept of standard deduction has always been introduced so that there is no concept of deduction of expense for a salaried class. So say I travel to my office and I'm incurring my expense for that. I don't really have, or no, I'm incurring related expenses relating to my office work. I don't have a specific deduction that is permissible. I'm always taxed on a gross basis on the salary income, and hence the concept of standard deduction has come in. So that's available for salaried class, and for pensioners it is 15,000. That's correct.
Absolutely. Then I think last one to go. What is the proper amendment regarding accommodation perquisites?
Accommodation perquisite, I'm just trying to look at it. Is it the house property one? Let me just pull it out. There was a amendment on section 17(2). I think there is some rule expected which will, I don't remember it offhand. Sorry, but I could respond to that if the question is a little more clear. I'm happy to take it offline.
Perfect. Great. So thank you so much, Saraswathi. It was a valuable session, and I think this is such a relevant topic for everyone. It will definitely benefit a lot of individuals.
Thank you so much. My pleasure, and always a privilege to be presenting at the Taxmann session. Thank you so much.
We had a great time having you.